Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffrey, and my guest today is Paul Galloway, who's also a member of the Senior Advisor Group at Strategic Treasurer. Today's topic is return on capital versus return of capital. Paul, welcome to the Treasury Update podcast again.
Yeah, thanks, Craig. Looking forward to this topic. It's an important one, an important concept for people to understand.
Since we spoke last time, we talked about the weighted average cost of capital, went through that. This time we're shifting to return on capital, but maybe to begin this conversation in this contrast of return of capital and return on capital, perhaps you could describe the concept or calculation of return on capital.
Sure. Kind of step back a little bit to our discussion around weighted average cost of capital, where we talked about a combination of cost of equity and cost of debt. And a lot of companies that are publicly traded today, they have a balance sheet that's made up of debt and equity. And so when you think about return on capital, it simply is your net income of the company less any dividends that you pay out, common dividends, divided by total capital, which is combination of equity and debt.
Thanks, Paul. So when people look at return on capital, how is this calculation used? Who uses it? Why is it important? I guess the other aspect of, if it's important, sometimes, of course, when is it most important?
Most people probably hear a lot of people talk about return on equity, which is a common financial metric that's used out on the street or markets or by investors. But when you want to look at what the total return that's being generated by an organization, well, you got to look at what are all the cost components to generate that return. And so what a return on capital does is it incorporates all that. So it takes into consideration all the revenue that you generate, less all your expenses, less your dividends. And it takes it in relation component to your equity, which equity in the arena of a publicly traded company is common stock. Debt, which is another way for an organization to get capital into the company or fund it, and it's typically at a cheaper cost. Return on capital gives both the equity investor or stock investor and the bond investor visibility to what return is being generated by an organization. And so that return is generated by several different ways. It can be investment in products and services that they deliver. It can be investment in mergers, acquisitions. It can be creation of new companies within the organization, or it can be investment in systems and technologies and people to generate more revenue.
Sure. So let's shift from return on capital to return of capital.
Yeah, absolutely. So these two components are really important and they're intertwined. The reason I say that is organizations have a limit to what they can get for return on their capital, meaning they're going to deploy it to the extent that they can get an adequate return to pay back investors or compensate investors plus some. When they make investments, they're looking at what the cost of the investment is, the capital associated with making that investment, and the return that they'll get. And so they'll deploy capital into these various things I talked about earlier. Once they've got to the point that they can't generate a return adequate enough to compensate the investors for the required return they have, the next best thing to do is return the capital back to the investors. So return on capital first. And once you've deployed all that to the maximum that you can't generate any more alpha return or return above the required capital, then you need to return it back to the investors. And there's a couple ways you can do that. traditionally for publicly traded companies, common dividends are the most used way or common practice for delivering capital back to investors. They can also do extraordinary dividends. So these would be dividends that aren't normally accrued for or accounted for in the markets. And generally, companies are given guidance to the street about what their dividend yield will be or their dividend payments will be. They'll have a dividend policy in place. Another good way for organizations to return capital back to investors is through share repurchases. And what's interesting about share repurchases is, think about a company, let's just say a company is worth $5 billion and they have 1 billion shares outstanding. I'm just making up numbers. And they go out in the market and they deploy $500 million to buy back shares. Nothing has fundamentally changed for the organization. It's technically, all things being equal, is still worth $5 billion. Now, what they've done is they've taken shares out of the market. So publicly traded company now has less than 1 billion shares out there. Let's say it's 900 million shares. If you have 5 billion divided by 1 billion and compare that to 5 billion divided by 900 million, your share price goes up. Investors like that. They want to get appreciation on their stock price. If they can get that, that's a good thing. That means they have more value in the stock that they hold than what they had before per share. Now, the total value of the company hasn't changed, though.
In that situation, that's the idea. If the math would work, if that's the case. Now, if you took out 500 million and you sent it back, in one sense, you've reduced the value of the firm because now it's $500 million lighter. The price per share should decline, at least initially.
One would think that would typically be what you would have happen. What traditionally happens, though, is that over the period of time post the acquisition of the share price actually will go up over the period of time. And so you can buy back shares in a couple different ways. So there's some rules around what you can and can't do because you don't want to be an influencer of your own share price. When you do share buybacks, you traditionally do that over an extended period of time. And you're buying a small pocket of shares back every day up to a certain parameter that you're allowed to. And so technically, if you're deploying capital by returning it to investors, yes, you have less capital within the organization. And you would think that your share price will go down. And so you can see that your share price might move a little bit, but over that period with the amounts that you're doing, you really shouldn't see a downtick in your share price. Your share price should technically go up over the period of the share buyback program.
I guess I would think that instantly the share price should stay the same, all things being equal. The lack of or the reduction of cash, which gives you flexibility, could make it worth slightly less because the power of flexibility in cash, there's some value there. But the fact that you've gotten rid of an asset that's not giving you as much return as the rest of the business means that it's going to be better over time. I think that's what you were saying with the time element of that.
Exactly. Some other factors associated with that, Craig, would be if an organization issued more debt, meaning they raised more debt to fund something. And sometimes organizations will raise debt capital, which is cheap, and pay off high cost equity by doing share buybacks with debt. So it's a leveraged share repurchase program that can give you a little extra juice in your share price. Now, assuming that your capital structure is still flush enough that you have dry powder for the future, meaning that if you need to access the debt markets to fund something, that you have the ability to do so.
Paul, the term return of capital, I believe, has several uses, and you can tell me which is the primary use or secondary use, but I wanted to give an example. Other people refer to return on capital, I believe, is just getting cash back. In the same way that you're saying, but maybe not through share repurchases. I don't know if you ever watch Shark Tank. Kevin, who's known as Mr. Wonderful, he usually sits in the middle and they're evaluating all these companies if they're going to invest in them. He very quickly wants to get into licensing deals where he gets a certain return for every item sold and he'll give money for it. And, he'll get a certain percentage. Then he's got something that plays after that. So in one sense, he seeks a return of the capital he put in and then this ongoing residual item. Is that more of an informal return of capital, just the concept, or how would you define what Kevin's doing on Shark Tank with that particular strategy?
It is what would be considered maybe a more informal return of capital. And the other thing that Kevin's doing there, so Kevin is thinking about both sides of the equation that we're discussing today. He's looking at what kind of return on capital can I get? And secondly, when can I get my capital back? And if I get it back quicker and I'm still able to generate return on the capital that I invested, I've reduced my risk. And so Shark Tank, the investors are making high risk investments. And they're always trying to figure out ways to protect themselves from the downside because there's a high probability that some of these investments are going to fail. And they do fail. Some of them are quite successful for them. Part of what Mr. Wonderful's doing, which, I really like him a lot in his thought process when he approaches these investments, he's trying to get both sides of the equation. And it is an informal return of capital. And when you're dealing with high-risk investments such as Shark Tank, there's really no other way to ensure that you're going to get capital returned to you other than doing some type of licensing deal or some kind of structure where they meet milestones, they return capital back to you, and you get some kind of return associated as they're deploying the service or the product that generates revenue.
He either has to wait until there's some kind of sale of the business or some transaction, or this allows him to diversify the flows and the return to get some sooner. So that makes a lot of sense.
It does.
When we think about these two scenarios, I was going to say, how are they compared and contrasted? And I think you've described that already from the front end and the back end side. How are they similar? How are they different? Is there anything else about differences or similarities that you'd want to tease out in this discussion?
So obviously, the key components of this are return and capital. Return on and return of capital can be different for every organization and how they deploy it. I think the important takeaway with this is that they are interrelated and that organizations really need to make sure they have a focus on these two key concepts. Managing this in an efficient way can really help drive a lot of value to an organization because people will recognize the effort that you're putting into play and understand better what the value proposition is for the investments that's made, whether you're an equity investor or a debt investor within the organization. So I think these are really key components. Optimizing how you manage it, I think, is really important. So hopefully organizations are keeping an eye on these two metrics.
Yeah, I guess the other thing, Paul, is there any other guidance, either looking at these two? I think you've explained really well, but we've only talked about weighted average cost of capital on this podcast, but other things like internal rate of return, return on investment, et cetera. Are there anything else, any other models that we should be talking about in future episodes?
Yeah, you hit on something that I think is really important. So internal rate of return or hurdle rate or any other kind of return on invested capital or return on equity components, organizations need to make sure that they understand, one, the risks associated with the types of investments they make and what the minimum required return is. So a required return is what I would equate to a hurdle rate. And a hurdle rate just really says, hey, company ABC, you make an investment in whether it's product or service or an M&A transaction or something else that would generate some type of cash flows into the future and have some kind of value either in perpetuity or finite cash flow period. You should be able to determine what the expected return would be on that and compare that to what I would call a benchmark rate, which is your hurdle rate or required return on capital. So these are important concepts that I think are kind of a stepping stone to what we've already talked about: weighted average cost of capital, return on return of capital. So then I think we can take another step and talk about, okay, how do companies view return and how should they? And what's the difference between internal rate of return versus net present value? Can they give you different answers? Do they give you good direction? Are they accurate? I think these things are important concepts that organizations need to have people in place that understand them, are able to communicate and educate to senior management team, and be able to complete analyses that derive value for organizations so that they can make good investment decisions.
Yeah, this sounds good, Paul. I look forward to some more discussions, as we talk about the equity and debt side of the balance sheet. And then we also have discussions about the debt and capital markets, whether you're securing loans or you're securing investors, the stewardship function of providing for liquidity, providing for the proper return and weighting these things out is there's just so much more to talk about. Paul, thanks so much for your time. Look forward to having you on another episode of the Treasury Update podcast sometime soon.
Thanks, Craig.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.